In the world of investing, few names resonate as strongly as Peter Lynch. His tenure at the helm of Fidelity's Magellan Fund remains legendary. He achieved extraordinary returns. Lynch's investment philosophy, however, is what truly sets him apart. He champions a common-sense approach to investing. He emphasizes understanding businesses, not just stock prices. This essay delves into Lynch's timeless wisdom, offering guidance for both novice and seasoned investors. Market volatility is an inherent characteristic of the stock market. It's a dynamic environment where prices can swing dramatically within short periods. This volatility can be attributed to various factors such as economic data releases, geopolitical events, and changes in market sentiment. While these fluctuations can be unsettling, they are a normal part of the market's behavior. It's not something to fear. In fact, seasoned investors often view volatility as an opportunity rather than a threat. By staying informed and maintaining a long-term perspective, investors can navigate these turbulent times with confidence. Understanding that the market's ups and downs are part of its natural cycle can help mitigate anxiety and promote a more strategic approach to investing. Instead, it's a natural part of the investment landscape. Diversification is a key strategy in managing volatility. By spreading investments across different asset classes, sectors, and geographies, investors can reduce the impact of any single market event. This approach not only helps in managing risk, but also in capitalizing on growth opportunities across various segments of the market. Lynch, with his decades of experience, understood this well. He emphasized the importance of thorough research and a disciplined investment strategy. Lynch's success was built on his ability to identify undervalued stocks and hold them through market fluctuations. His approach serves as a valuable lesson for investors looking to build wealth over the long term. He witnessed numerous market cycles. Each cycle, whether a bull market or a bear market, presented unique challenges and opportunities. By studying historical data, investors can gain insights into how markets have behaved in the past and use this knowledge to inform their future investment decisions. He saw firsthand how markets ebb and flow. Declines are inevitable. They are a natural part of the market's rhythm. During these periods, it's crucial to remain calm and avoid making impulsive decisions. Panic selling can lead to significant losses and missed opportunities for recovery. They are a regular occurrence in the market's history. Market corrections, which are declines of 10% or more, happen frequently. These corrections can be triggered by various factors, including economic slowdowns, changes in interest rates, or geopolitical tensions. While they can be unsettling, they also provide opportunities to buy quality stocks at lower prices. Corrections, which are declines of 10% or more, happen frequently. They serve as a reminder that the market is not a one-way street. By maintaining a diversified portfolio and a long-term perspective, investors can weather these corrections and potentially benefit from the subsequent recovery. Larger declines, known as bear markets, also occur periodically. These are more severe downturns, typically defined as declines of 20% or more. While bear markets can be challenging, they are also a natural part of the market cycle. Historically, bear markets have been followed by periods of recovery and growth. These downturns are not reasons to panic. Instead, they represent opportunities. Savvy investors use these periods to reassess their portfolios, identify undervalued assets, and make strategic adjustments. By staying informed and maintaining a disciplined approach, investors can turn market downturns into opportunities for long-term growth. One of Lynch's most crucial pieces of advice is to invest in what you understand. This means taking the time to research and comprehend the business model, the industry it operates in, and the competitive landscape. By doing so, you can make more informed decisions and avoid investing in companies that you don't fully grasp. Before buying a stock, understand the underlying business. This involves digging into the company's financial statements, understanding its revenue streams, and knowing its customer base. It's not just about the numbers, it's about the story behind those numbers. What drives the company's growth? What are its strengths and weaknesses? What does the company do? This fundamental question helps you grasp the core operations of the business. Is it a tech company developing innovative software or a manufacturing firm producing essential goods? Understanding the nature of the business is the first step in evaluating its potential. How does it make money? Is it profitable? These are fundamental questions. You need to know the company's revenue model and whether it has a sustainable path to profitability. Look at its profit margins, cash flow, and debt levels. A company that consistently generates profits and manages its finances well is often a safer investment. They should guide your investment decisions. When you have a clear understanding of a company's fundamentals, you can make more rational and less emotional investment choices. This approach helps you stay focused on long-term goals rather than getting swayed by short-term market fluctuations. Once you own a stock, don't panic when the price drops. Price fluctuations are common. The stock market is inherently volatile and prices can swing due to various factors, including market sentiment, economic data, and geopolitical events. It's important to stay calm and not let short-term volatility affect your long-term investment strategy. They're often driven by short-term factors. These can include quarterly earnings reports, changes in interest rates, or even news headlines. While these factors can impact stock prices in the short term, they don't necessarily reflect the company's long-term value or its ability to generate profits in the future. Instead of fixating on price, focus on the business. Look at the company's fundamentals, its management team, and its competitive position in the market. If the business is strong and continues to perform well, the stock price will eventually reflect its true value. If the fundamentals remain strong, hold on to your stock. Patience is key in investing. By focusing on the long-term prospects of the business and ignoring short-term noise, you can build a more resilient and profitable investment portfolio. Even the most successful investors make mistakes. Peter Lynch is no exception. He openly shares his investment setbacks as learning experiences. One such experience involved Kaiser Industries. Lynch bought the stock at $16 per share. He believed it was undervalued. However, the company's complex structure and heavy debt load proved problematic. The stock price plummeted. Lynch learned a valuable lesson. Thorough due diligence is essential. Investors must understand a company's financial health before investing. Section 5. The long game: time, not timing. Lynch is a staunch advocate for long-term investing. He believes that time, not timing, is the key to significant returns. He often cites his investments in companies like Taco Bell and Pepsi. He held these stocks for years. He rode out market fluctuations. His patience was rewarded with substantial gains. The lesson is clear. Identify companies with strong growth potential. Hold on to those investments for the long haul. Don't get sidetracked by short-term market noise. Section 6, 1987, a case against market timing. The 1987 stock market crash was a dramatic event. It shook many investors. Peter Lynch, however, remained calm. He famously recounted that he was on a golf trip during the crash. He didn't panic. He didn't try to time the market. This event underscores Lynch's belief in the futility of market timing. Even seasoned professionals cannot consistently predict market movements. Trying to time the market is often a recipe for disaster. Section 7. Diversification, two-headed coins, and portfolio success. In this section, we delve into one of the most crucial aspects of investing: diversification. It's a strategy that can make or break your portfolio, and understanding it is key to achieving long-term success in the stock market. Diversification is a cornerstone of Lynch's investment strategy. By spreading your investments across a variety of assets, you reduce the risk of any single investment significantly impacting your overall portfolio. This approach helps to smooth out the inevitable ups and downs of the market. He advocates for spreading your investments across multiple stocks. This means not putting all your eggs in one basket. By investing in different sectors and industries, you can protect yourself from the volatility of any single market segment. He uses a vivid analogy to illustrate this point. Imagine a two-headed coin. You flip the coin. One side represents your winners and the other side represents your losers. This analogy simplifies the concept of diversification, making it easier to understand. One side represents your winners. These are the stocks that perform well and generate significant returns. They are the backbone of your portfolio, driving growth and profitability. The other side represents your losers. These are the stocks that don't perform as expected and may even lose value. However, in a well-diversified portfolio, the impact of these losses is minimized. Even with some losing investments, your overall portfolio can still perform well. The gains from your winning stocks can offset the losses from the losers, leading to a balanced and resilient portfolio. Lynch suggests holding 20 to 30 stocks in a portfolio. This range provides a good balance between diversification and manageability. It allows you to spread your risk without becoming overwhelmed by the sheer number of investments. This provides a good balance between diversification and manageability. By carefully selecting a diverse range of stocks, you can build a portfolio that is both robust and easy to manage, setting yourself up for long-term success in the world of investing. Section 8. Patience, the unsung hero of investing. Patience is often overlooked in the investment world. We live in an age of instant gratification. However, investing requires a different mindset. Building wealth takes time. It requires patience and discipline. Lynch emphasizes this point repeatedly. He stresses the importance of allowing your investments to grow. Don't be tempted to sell too early. Remember, time is your ally in the market. Section 9. Conclusion, Lynch's enduring lessons for the modern investor. Peter Lynch's investment wisdom remains as relevant as ever. His emphasis on understanding businesses, embracing volatility, and taking a long-term perspective provides a timeless roadmap for investors. He reminds us that investing is not a get-rich-quick scheme. It's a process of careful research, prudent decision-making, and unwavering patience. By embracing these principles, investors can navigate the complexities of the market and work towards achieving their financial goals.